Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for joining us and giving us a few minutes of your week. Just kind of hear our thoughts on the market. This week, we're going to be a little bit different because we want to stay on point. We're a week after the news cycle here, but that's just the way things roll. But for us, we want to spend the time just focusing on the U.S. downgrade. That's one of the bigger topics from last week, and headlines certainly could shake things up. But we wanted to really give you our take, what it means, what it could mean investment-wise. So let's just jump right into it. And just to set the stage and to have us all on the same page, what ratings agency and the roles that they play. So if you're an investor and you're buying into stocks, essentially you're making a wager on the future. You're buying earnings growth. You're buying something that will appreciate over time on the net. When you're buying bonds, your first order of business is to get your money back. Hopefully you'll earn some interest along the way. And that's a difficult task for most investors to really have the wherewithal to judge the ability of getting that money back and the certainty. That's where the ratings agencies step in, and they provide a rating system so investors can use that to make an assessment on the likelihood of getting that money back. And so the ratings, they vary a little bit by the agencies, but there's three primary ones: Fitch, Moody's, and S&P. You can see them there on your screen, but the way the ratings work, AAA is solid gold. That is a high degree certainty. Call it just certain, like one of the few things in the investment business of getting your money back, or as close to it as you could be. AA then is right below that, and then of course you go A. Triple B, that is the last, what we call investment grade. When you go below that, and then double B, that's what's considered junk, or a lesser degree, less likelihood of getting your money back, and then so on and so forth below that. So triple A is the ratings that the U.S. Had the privilege of having for many, many years. And we have seen that deteriorate here as of late, but we want to drill into what that means. But first, the S&P was the first to do this in 2011. If you take yourself back to that time frame, we really had a struggle with getting a budget passed. That was the first time we really had, or at least in a major way, the debt ceiling used as a tool to negotiate budgets, and really threatened for a short period of time the U.S.'s ability and whether or not they would be able to actually redeem those bonds at par and have those bondholders made whole. That was enough for S&P to say, hey, we are downgrading you, not to junk or anything like you might see in an emerging market, but to AA plus. That's that red line there. Fitch and Moody's, meanwhile, temporarily put it in the green, which would be a negative outlook. Leave it to the ratings agencies, by the way, here to have a color code that can be kind of funky. Green we don't typically associate with negative, but that's what it is. And then AAA with a negative watch was maintained by Fitch until they backed off and kept it at AAA with a stable outlook through 2014 and on into COVID. But here we have 2023, seemingly out of the blue. Fitch joins S&P with a AA rating, or AA plus, which just one rung below AAA. And so now what we have, and the significant change, is that we have a majority of the three rating agency not giving the AAA gold to the United States. So I would emphasize the two reasons for this. Number one, of course, is a growing debt load and becoming more cumbersome to pay back. The ratings agencies do factor in inflation, and inflation deteriorating a nation's currency essentially is getting less of your money back. But maybe more importantly is that we once again saw the debt ceiling used as a tool. So the more that becomes the norm, the greater risk holders of the U.S. Government debt face in terms of getting their money back and on time. So that's really the background. I want to flip and hand it over to Andrew to kind of walk you through a little bit more of what that means. I just kind of give you my last 2 cents. I would borrow from Voya, who is a fixed income manager that pay a lot of attention to, and they summarized it well, that it hopefully gives the U.S. a kind of a wake-up call to take a journey of self-discovery but wasn't really a doomsday type of an event. So, Andrew, I'll have you kind of put more color on that punchline.
Yeah, so Adam did an excellent job, as always, of describing kind of what the downgrade, the implications for what caused it, how it happened, kind of the history of that. The next kind of natural topic that we have is if you were going to kind of go through the gameplay of what if there was this doomsday scenario, like Adam said, is very unlikely, but you saw this rush out of US debt. Everyone wants to sell their American bonds. To have that happen, you have to have alternatives. It's a similar conversation when we talk about the dollar, when we get asked, is the dollar going to crash? Is there going to be a crisis in the dollar? The money has to go somewhere. When it's the dollar, it has to go to another currency. When we talk about US bonds and our ratings being downgraded, if people are institutions, pension funds, sovereign funds, if they're to sell US bonds, they're likely not going to start buying equities or Bitcoin or farmland with that debt. They need with those assets. They need something that's a very highly liquid market, something comparable as far as risk appetite for that bond. So we have to start looking what are the alternatives to U.S. bonds, and really to do that, you need a very liquid market, and there's essentially three with a quasi fourth option that are available to kind of look at what are the alternatives would be. First, you have Japanese bond market. The issue there, it's very large, but it's not really a free market. Japan heavily controls their debt market. They've had yield curve control for a decade plus, longer than that, really since kind of the 90s. They've really been kind of manhandling their markets, owning of more over half of their outstanding debt, and now they're actually starting to own a lot of their equities and ETFs as well. But Japan is very much not so much of a free market like we would expect here in the US. Next, you'd have German bunds. They spell it B-U-N-D instead of B-O-N-D, but German bunds would be kind of the next option, a very established dominant market being Germany. But the issue is they're tied to the Eurozone. They're tied to the Euro. And we've seen time and time again over the last, since kind of the 90s, but more recently in the last decade, where they have a lot of crises, whether it's monetary, where you have different countries that start having major issues. You might remember when like Spain and Greece had started to have default issues, and they're all tied together with the euro. So we also had most recently the environmental crisis in Europe, where recently we're seeing natural gas prices in Europe spike again, but where they have climate issues, they have issues obviously with going on with Russia and other geopolitical concerns. But when you have a country that doesn't have control of its currency, that very much ties to their debt. And that's going to be one of the big implications for Germany is they don't have control of the euro. They're tied to a bunch of other countries. And when in fact we started seeing countries leave the Eurozone, like when we had the United Kingdom leave, and they didn't even adopt the euro because they saw so many issues with it. So Germany, their connection to the euro makes it a little bit harder of a market to trust and not so much of an apples to apples comparison to something like the US bond market. Next, you have China. China, another obviously very large economy. The issue is they have a lot of geopolitical issues. Right now, they're not one of the most trusted countries. They also don't have a very liquid market. So if you were going to see trillions and trillions of dollars flow out of U.S. debt, there's not enough liquidity there in China on their bond market to really absorb a lot of that. So it's not a great alternative there. So the next option you have, like you can see on the screen, is some of the other still AAA rated countries. And so you have Denmark, Netherlands, Sweden, Norway. You could have possibly a mixed basket of some of these other AAA rated debt. The issue is, again, there's still not a lot of liquidity there. You have countries like Canada, but they're still very much tied politically and military-wise to the U.S. And so just a lot of the issues, if you were to see something really happen in the U.S., it would have rippling effects to a lot of these other smaller countries, especially our neighboring borders like Mexico and in this case, Canada. And so when we look at the issues with what could happen with this downgrade, you have to say, okay, if the money's going to leave, it has to go somewhere else. And right now, the U.S. may not be the prettiest pig in the pen, but it actually is. It's still the prettiest pig in the pen because we still have issues, but it's still one of the largest markets, most liquid markets, still one of the strongest military, strongest economies, and most importantly, one of the freest markets for fixed income and sovereign investors to start looking for as far as fixed income goes. And the same conversation applies when we talk about the dollar. So while it is a concern that we see the downgrade, of course, we don't want our debt to be downgraded. The positive, and I would echo what Adam said, is maybe it does provide a wake-up call to some of the issues that Fitch raised and S&P has raised in the past. And here, really, Moody's is starting to do the same of some of the issues going on politically and then fiscally within the U.S. borders. And maybe they start to get addressed and fixed, and maybe we'll get our debt upgraded again. But as far as our investment portfolios, we're not looking at this as a major concern. There's much other larger issues that we could see on the fixed income front outside of just a debt downgrade. So this isn't a major issue in our eyes as far as how bonds are going to be priced. We do think it's still important, but not a crisis red flag as maybe some news stories ring it to be. So hopefully this provides some good insight on kind of what the downgrade is, how we view it, maybe make it a little bit less scary of a headline as some news stories put it out there as. If you, of course, have questions, we're always more than happy to answer those and have those conversations, especially when you meet with your advisor. They can do that as well.
Yeah, excellent breakdown. Again, Andrew, I would say, as always, kind of the finishing touches to that, I would say we have a checklist internally that we would go down to check what we would consider to be the financial plumbing of the market. Signs where you would see distress, a whole lot of acronyms in terms of measuring interest rates and what the moves were after the announcement. Because the timing wasn't expected, it was a surprise announcement. And that is exactly the type of announcement that can cause ripples when people aren't expecting it, that you could see volatility where expected. And we saw no real signs of distress in the money markets. And so to us, that's the most comforting thing is we have all this background, we have all the rationale, but in the end, we have confirmation from the markets that they viewed it as a non-event. And so that gives us great comfort as well. So we're all in the same boat. Let's just hope that we can find some way to work ourselves on a path back to that AAA status. So, hey, thank you as always. We'll give you a reminder here to give us a call, 800-928-4001. If we can be of help to you, please give us a call. We'd love to meet you. Or if we haven't seen you, or we have a chance of currently working with you, give us a call, set up your meeting, or scan the QR code. And thank you again, and have a great weekend.